Anyway, so the reason why we are taking that this company, they are owners in S Limited, and they are owners in Ajab Limited. Let me use S and A, but you know which companies I'm referring to. So they are owners there. At the same time, they are receiving dividend in the company which they own. So it's like you are paying yourself as a director, and yet you account it as investment income. That's why we have to exclude that the dividend they are paying from their owner from the other investment. So it should be one. So you should not pay yourself a dividend in your own company, which you own the 80% of the shares. So that's why we have to exclude that 80%. 80%. The same with this, we have to exclude the 40%. What is equapa? At the same time, at the point of acquiring this company, you also acquire or maybe you pay their loan. So if you pay their loan, it means that you have invested your money, you give out your money as a loan to your another company, and you charge an interest. So it's like you are charging an interest on yourself. Okay, that's why we have to subtract that 10% of the loan stock. And also we'll have to subtract here. So that is it. Now for the impairment, we have first to calculate the goodwill. We will calculate the goodwill on the subsidiary and the associate. Then we multiply by the rate which you have been given. And I hope you have not forgotten the note which we said for the goodwill. For the goodwill, you simply take the purchase consideration minus net share of assets minus net share of asset minus net share of asset. And with this net share, we have a lot of them. Also, the next thing which you need to ask yourself is, which method am I going to use? Is it the partial or full method? How do you identify whether it is a partial or a full method? If examiner has given you the fair value of NCI, non-controlling interest. If the examiner has given you the fair value of non-controlling interest, it's simply telling you to use full method. It's simply telling you to use full method. Full method. So I will take that is S and A, and then take the purchase consideration. They are given us in note number 1. In note number 1, we have all those information. We have been told shareholding out of the purchase. So we have 300 million for this. And then this is associated. So I can also have non-controlling interest here, NCI. So the fair value of non-controlling interest, fair value, we have been given in the note number 2. The fair value of non-controlling interest in Shuka was 75 million. So it's same as the cost of purchase consideration. I put the fair value 25 there. What is the cost of Ajab? We bought the Ajab at 200 million. So with that, you simply say less share of net asset. Less the share of net asset. Less the share of net asset. So what did you say in our format about the share of net assets? Say to take the ordinary shares, share capital, share premium, the retained earning, but specifically pre-acquisition, not post-acquisition, but before acquisition. And if there is any revaluation of an asset before the acquisition, we include there. So let's check our ordinary shares before acquisition. Before acquisition. We have taken a copy of this. This kitabu ya first paper inanisumbua. Now, What is the share of ordinary shares? Go to the column of balance sheet, equity and liabilities. We have that is the total we need at the date of acquisition, which is in note number 1. So if you go number 1, tumepewa the revaluation reserve. Yeah, we have the revaluation reserve, which also we'll have to include. So put the revaluation reserve. They have given us the revaluation. So how much do we have for revaluation? 20 million. And the other one is 25. For this is 25. No, for this is 25. Now, what else do we need? The retained earning at the beginning. They have given us there. We have the retained earning, retained profit. We have 180, 180 and, 80 and 150. 80 and 150. Ordinary shares. Ordinary shares. Just pick whatever we are writing in the balance sheet there. So we have 200 and 200. For Shaka, we have 200 and also 200 here. We have the share premium. Yes, there is a share premium. Share premium. Share premium, we also have 50 and 50. 50 and 50. Now, so this one also, it is the same. You take the same 80, 200 and 50. So get the total. Get the total. Get the total. Get the total. We can get 20 plus 80 plus 200 plus 50. 350, it will be the same. Now, are we taking the entire 350? Are we taking the entire 350? Oh, let me touch those. So we are not taking the entire this one, but we are taking 80%. So multiply by 80%, this one multiply by 20%. So what do we have here? So I will take 80% of 350 to give me 280. What about this? 350 multiplied by 20 to give me 70. Take this minus this. 300 minus 280 to give me a goodwill of 20 and goodwill of 5. Since we are using a full method, combine the two. Combine the two to give us a total goodwill of 25. To give us a total goodwill of 25. To give us a total goodwill of 25. This one again, 25 plus 150 plus 200 plus 50, we are getting a total of 425. Multiply by 40%. Multiply by 40% to give us 170. Take this minus this to give us a goodwill of 200 minus answer. You have a goodwill of 30. You have a goodwill of 30. Any question to the goodwill? Any question to the goodwill? Any question to the goodwill? So now we have the goodwill for this and we have the goodwill for that. Examiner was saying, how much do we charge for the depreciation or impairment of goodwill? He said that all the goodwill of the two companies in which the HEMA Limited has invested are estimated to be impaired by 60%. So all the companies are estimated to impair by 60% to the year ended 30th April 2017. 20% of the impairment relate to the current year. So 40 is for the previous financial period. So we will not consider that. We only need for the current period because you only account expenditure for 1 year. You can't account expenditure for more than 1 year. So for us to get the depreciation for the current year, I will have to take which is here, combine the two. So you will take 60 minus 20, which will give us 40%. So take 40% of the 25 plus 30. 25 plus 30. So 40% of 55, 40%, no, 20 is relating for the current year. So it will be, we only consider 20 because we'll be told only 20. Okay, 60% of this, and then take 20, 60% of 55, which is 33, but only 20 relates to the current year. So multiply by 20% to give us 6.6. 6.6. So that is the impairment for the current year. Now subtract this to give us the profit before tax. Get the total income here. 866. Subtract all this. Minus 210. Minus 140. Minus 50. Minus 6.6. To give us 49. 459.4. Subtract 120. Minus 120. To give us 339.4 as a profit. The profit after tax. The profit after tax. So that is a profit after tax. Let's get now for the profit in associate. The post profit in associate. The post profit in associate. Let's get the post profit in associate. Post profit in associate. Was that what we need to add there? Control so that I can have at least a space here. So I will say add in associate. In associate. So let's get that profit in associate. Profit in associate. Profit in associate. So, and this is post profit. What does that mean when you say post profit? That is after acquisition. After acquisition. After acquisition. After acquisition. After acquisition. So, in one financial period, you can see AJAP. They are reporting to us the consolidated profit for the year, which is the retained earning at the end of the year in your balance sheet, 200. So that is the total profit at the end of the year is 200. But what was the profit for the year? Profit for the year ilikuwa ngapi? Ilikuwa uko juu umepewa profit for the year ni 160. Profit for the year 40. So they are reporting 200 at the closing of the year, 200. Profit for the year is 40. So the profit at the beginning is, take this minus this. So the profit at the beginning is 160. 160, which even you can say there, you can see there, retained profit put forward, we have 160 there. So for us to get this, for us to get that. Now, out of that, what was the profit before acquisition? The profit before acquisition ilikuwa ngapi? 150. Are you seeing 150? Are you seeing 150? So, in short, you will take the retain or what they reported it as a profit at the end of the year, which is this plus this, ikakuja ngapi to 200. But at the time of acquisition, which is you just need to say retain earning of the profit, you take that 200 minus 150, because this 150 was at the acquisition. So the remaining extra is what is called the post-acquisition profit. So take that. Any revaluation, there is a revaluation gain. Remember, revaluation gain also is being included in the retained earning. Revaluation gain is being included in the retained earning. How much is our revaluation gain? If you go to your profit and loss account or P&L balance sheet, there's a revaluation of 50, revaluation reserve of 50, but that 50, 25 is relating at the beginning of the year. So, but this 50 is for the entire period. So you take 50 minus 25, you get post revaluation reserve. So we have revaluation, which is 50 minus 25. So you get post. Now, the amount you are getting here, you multiply by the percentage of the associate. We only own 40%. We only own 40%. We only own 40%. We only own 40%. So let's get that. 50 multiplied by 40%, which will give us 20. This one again, 50 minus that, we get 25 multiplied by 40, it will give us 10. That one 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 will give us 10. Now, but our main interest is to get the profit in the associate. So this one, because it is retained earning, so we will accumulate it in the non-controlling interest. So our main concern is for this only. Our main concern is for this only. That is our main concern. Our main concern. That is our main concern. Which I'm reporting happy the net profit. Profit for the year. Profit for the year ni ngapi? Profit for the year. For the year. Profit for the year. Actually, tulikuwa tumepick the wrong one. Hiyo 40 ilikuwa. This one is the retail earning. This one is the retail earning. 40 is the retail earning. Profit for the year after subtract income tax inakuja ngapi? 70. And see 70. So this 70 is the one which we want here. So after, because the after acquisition, which they are to 160, then waka make a profit of 70. So this is what is called the post profit. The post profit. The post profit. So with this post profit only, we only need 40%. So 40% of our 70, which will be 40% of 70, 28. So that you can have add that. So 339.4 plus 28, we have a total of 367.24. Let's get the profit in associate, not associate, but non-controlling interest. Profit in non-controlling interest. Profit of non-controlling interest. Profit of non-controlling interest. So how do you get the profit of non-controlling interest? How do you get the profit of non-controlling interest? So for non-controlling interest, how much have they reported for the year? If you go to the profit and loss account, if you go to the profit and loss account, I can see in the second column, 150. So they have reported a profit of 150. But with this 150, there is unrealized profit. There is unrealized profit. There is unrealized. Was it upward or downward? Hizo sales zingine, that's why we had to know, is it a downward or is it upstream or downstream? Ever sold good too. So there is no downstream. There is no upstream. There is no upstream. There is no upstream. So we only add the depreciation overcharge. This depreciation overcharge. It will only affect the two companies because this depreciation overcharge, the parent and subsidiary, they account that amount. So we'll add back this one because they overcharge depreciation. What happens if you overcharge depreciation? Reduce your profit. So we add back that profit. So plus 8, plus 8, plus 8, plus 8, plus 8. So whatever you get, our qual they charge, they have not charged this one, impairment. They have not charged the impairment. They have not charged the impairment. So after this, subtract the impairment. Subtract the impairment. This is the total impairment for the subsidiary and the associate. So move for the associate, the pattern up 60% of 25. Whatever you get multiplied by 20, how much are we getting? 60 multiplied by 25 multiplied by 20%. You're getting 3. Now, you're getting 3. So, if we are getting 3, how much does the associate control? We are remaining with the parent. The parent control only 80% of this. So which means the remaining for MCI is 20%. 20%. So with this one multiplied by 20, 3 multiplied by 20 tutakuwa na ngapi? So 20% multiplied by 3, we get 0.6. So I will subtract 0.6 here. 0.6. So whatever you get here, multiply by the control which we are controlling, which is 20%. 20%. So itakuja ngapi? 150 plus 8. Tatupia 158 minus 0.16 to give us 157.4. Multiply by 20%. Give us 31.448. 31.48. Or you can round off. So here we'll have 31.48. So profit for the parent, we take this minus this. So 367.4 minus answer, you get 3335.92. So this is the profit for the parent. That is the profit for the parent. That is the profit for the parent. Najua nimezungumza sana. Hujaongea. Unajua maybe hii ya depreciation hii ya goodwill imekuchanganya. So if you don't want to go this long method, you can just pick what is the goodwill of NCI. Just take a look. So any questions? Any questions? So we don't want to take the long way with this impairment of goodwill in associate, in a impairment of goodwill on NCI, it will be very easy. So you don't want to go in that long route, which you take the purchase consideration, which is 75, or the value of NCI, simply the value of NCI, which they have given us in note number 2, and then you less the percentage or the share of net asset less share of net asset of NCI. Let's share of net asset of which tulikuwa tumepata is just a repetition. Ukiangalia hapo goodwill tulikuwa tumepata. So the total asset of net share ilikuwa 350. Take 20%. Ukichukua 20% inakupea ngapi? 70. Si tulikuwa tumepata 70. So if you take this minus that, you get 5 as a goodwill. This is the goodwill of NCI. So if this goodwill of NCI, we have been told 60% will impair, so multiply by 60%. So 60% multiplied by 5, which will give us 3, which tulikuwa tumepata 3. So tulipata 3, yeah. And then these 3, only 20% relate for the current year, so which will give you 0.6. We'll arrive at the same value. So you can choose to go in the other direction, or you can use that one. So we are done with that. I will not start the P&L saizi. Enda kwanza udigest hiyo, tukuje tuanze balance sheet. In our next class. So we do the balance sheet and then we start another approach. This is the balance sheet approach. Now you will be given an income. No, we have done income and the balance sheet. After that, we will do a balance sheet approach. You will not be required to prepare this one, but you will require to prepare the balance sheet alone. So we'll have to do the two. income and the balance sheet and the balance sheet alone. Zote mbili lazima ujue. So enda utajesti hizi polepole. Meet on Wednesday, Thursday, finish. Any question? Lea, any swali? Una swali?